Hello and welcome to this webcast on IFRS 17 insurance contracts. We will be providing an overview of the amendments to IFRS 17 made by the International Accounting Standards Board in June 2020. You are listening to Part 2. The amendments are aimed at helping companies implement the standard and making it easier for them to explain their financial results. My name is Vitalina Kabirnik and I am a member of the technical staff here at the ISB.
My name is Laura Kennedy and I'm also a member of the technical staff.
This webcast is split into two parts. In this part, Part 2, we will talk about the new transition reliefs introduced by the amendments to IFRS 17. Part 1 is a separate webcast and is about the amendments to the IFRS 17 requirements other than transition. Before we start, as usual, the views expressed in this webcast are our own and not necessarily those of the International Accounting Standard Board or of the IFRS Foundation. A copy of the slides used in this presentation is available for download via the IFRS Foundation website. Since IFRS 17 was issued in May 2017, the board has been supporting implementation through various activities, including publishing educational materials such as articles, pocket guides, and webcasts. The webcast series on IFRS 17 includes 11 webcasts on key aspects of the requirements of the standard. The first 10 webcasts were published before IFRS 17 was amended. This webcast on the amendments is the 11th in the series. The majority of educational materials published before IFRS 17 was amended is unaffected by the amendments. However, some aspects of the requirements covered in those materials may have been amended, and some aspects, while not amended, will be closely connected to the amendments. Caveats have been added to the educational materials on our website to remind you to also take a look at the materials on the amendments to IFRS 17.
Next, we'll walk through each of the amendments to the transition requirements. 3 of the amendments we will talk about are connected to the amendments to the core requirements discussed in Part 1. This webcast, Part 2, is most closely connected to the 7th webcast in the IFRS 17 webcast series on transition. However, each amendment may have some connection to other webcasts. For example, we talk about the prohibition from applying the risk mitigation option retrospectively in the 10th webcast in the series on contracts with participation features. It is worth noting the amendments to IFRS 17 do not affect the transition reliefs that were already available in IFRS 17 as originally issued in 2017. Before we walk through each transition amendment, let's go through a reminder on transition dates and transition approaches for IFRS 17. In Part 1, we talked about the deferral of the date from which entities are required to apply IFRS 17. From 1st of January 2021 to 1st of January 2023. That amendment affects the mandatory transition date to IFRS 17 and comparative period that the entity restates accordingly. The date of initial application is the beginning of the annual reporting period in which an entity first applies IFRS 17. And so, if an entity has an annual reporting period 1st of January to 31st of December and does not choose to early adopt IFRS 17, the date of initial application will be 1st of January 2023. The transition date is the beginning of the earliest restated comparative period presented when the entity applies IFRS 17. An entity is required to present one restated comparative period but can choose to present more than one restated comparative period. If the date of initial application is 1st of January 2023 and the entity presents one comparative period, the transition date is 1st of January 2022.
The transition approach is determined for each group of insurance contracts that exists at the transition date. The full retrospective approach is required by IFRS 17, unless impracticable. Applying a full retrospective approach, an entity measures a group of insurance contracts as if the entity had always applied IFRS 17. If a full retrospective approach is impracticable, an entity can choose to measure a group of insurance contracts at the transition date, applying either the modified retrospective approach or the fair value approach. An entity can apply each modification in the modified retrospective approach only to the extent the entity does not have reasonable and supportable information to apply a retrospective approach. In this webcast, we will refer to the modifications as reliefs. And if an entity does not have reasonable and supportable information to apply the modified retrospective approach, the entity is required to apply the fair value approach. For more information on the transition approaches in IFRS 17, listen to our earlier webcast on transition, which is the 7th webcast in this series. We will now talk about 3 amendments to the transition requirements that are connected to the amendments of core requirements discussed in Part 1. The first amendment relates to the measurement of a loss recovery component on reinsurance contracts held at the transition date. In Part 1, we talked about the amendment for reinsurance contracts held, which requires an entity to recognize an amount for loss recoveries from reinsurance contracts held. At the same time, it recognizes losses on initial recognition of onerous underlying insurance contracts. Applying a full retrospective approach at transition, an entity will determine the loss recovery component of a group of reinsurance contracts held that would have been recognized at initial recognition of the onerous underlying insurance contracts, and will roll that loss recovery component forward to the transition date, applying the usual IFRS 17 requirements for subsequent measurement at each reporting date between initial recognition of the onerous insurance contracts and the transition date. Applying the transition relief in the modified retrospective approach or fair value approach, an entity determines the loss recovery component of a group of reinsurance contracts held at the transition date in a more direct way, based on information at that date. It does this by multiplying the loss component of onerous underlying insurance contracts at the transition date and the percentage of claims the entity expects to recover from reinsurance contract held, using its expectation at the transition date. Applying that relief, the entity is not required to calculate what the loss recovery component would have been at initial recognition of the onerous underlying insurance contracts, or at any reporting date between initial recognition and the transition date. It is worth noting that in the modified retrospective approach, an entity applies the relief only if the reinsurance contract held was entered into before or at the same time as the onerous underlying insurance contracts. This is consistent with the requirements going forward, which we discussed in Part 1. If the entity does not have reasonable and supportable information to apply the relief in the modified retrospective approach, the entity assumes the loss recovery component is nil at the transition date. In the fair value approach, an entity is not required to identify whether the reinsurance contract held was entered into before or at the same time as the onerous underlying insurance contracts, and this is consistent with other requirements in the fair value approach that do not require the use of past information.
The second transition amendment that relates to Part 1 is about assets for insurance acquisition cash flows recognised at the transition date. In Part 1, we talked about the requirements for an entity to allocate a portion of insurance acquisition cash flows directly attributable to a new group of contracts to future groups expected to include renewals of the initial contracts, applying a systematic and rational method of allocation. As part of that amendment, the Board also amended the transition requirements to clarify that an entity recognises and measures assets for insurance acquisition cash flows as if IFRS 17 had always applied, except that an entity is not required to assess the recoverability of any such assets before the transition date. As a reminder, the main amendment discussed in Part 1 of this webcast has the consequence that assets for insurance acquisition cash flows will be of longer duration, and hence of a larger amount, and so the board has added transition reliefs for those entities where the measurement of the assets applying a full retrospective approach is impracticable. Applying the relief added to the modified retrospective approach, an entity will measure an asset for insurance acquisition cash flows using reasonable and supportable information available at the transition date. An entity allocates any insurance acquisition cash flows paid before the transition date, excluding those relating to groups of contracts that have ceased to exist at the transition date, between two types of groups. A. Groups of insurance contracts that are recognised at the transition date. Insurance acquisition cash flows relating to such groups adjust the contractual service margin of that group to the extent insurance contracts expected to be in the group have been recognised at that date. And B. To groups of insurance contracts that are expected to be recognised after the transition date. Insurance acquisition cash flows relating to those groups are recognised as an asset at the transition date. In performing that allocation, an entity uses the same systematic and rational method the entity expects to use after transition. If an entity does not have reasonable and supportable information to apply the relief in the modified retrospective approach, the entity determines amounts relating to insurance acquisition cash flows paid before the transition date to be nil. Now let's move on to the relief in the fair value approach. In applying the fair value approach, an entity determines an asset for insurance acquisition cash flows at an amount equal to the insurance acquisition cash flows the entity would incur at the transition date to obtain specified rights. Those rights are A. The right to recoveries of insurance acquisition cash flows from premiums of insurance contracts issued before the transition date but not recognised at the transition date. B. The right to future insurance contracts that are renewals of contracts recognised at the transition date and renewals of contracts issued before the transition date but not yet recognised at the transition date. And C. The right to future insurance contracts, other than those I've already described, after the transition date without paying again insurance acquisition cash flows the entity has already paid. The third transition amendment related to Part 1 is about the effect of previous interim reports. Applying IFRS 17 as amended, an entity is permitted a choice whether to change the treatment of accounting estimates made in previous interim reports when preparing subsequent interim reports and the annual report. An entity might choose not to change the treatment of accounting estimates made in previous interim reports, but not have the required reasonable and supportable information to apply that choice retrospectively at transition. The transition amendment provides a relief for such circumstances. Applying the relief, an entity will determine the contractual service margin or loss component at the transition date as if the entity had not prepared interim financial statements before the transition date.
So far, we have walked through 3 of 6 amendments to the transition requirements, being the 3 which relate to the amendments to the core requirements discussed in Part 1 of the webcast. We will now talk about the 3 remaining amendments to the transition requirements. The first additional transition relief relates to the specified initial assessments required by IFRS 17. In the modified retrospective approach and fair value approach, IFRS 17, as originally issued, permitted an entity to use information available at the transition date instead of information at initial recognition to perform the following initial assessments. First, identifying groups of insurance contracts. Second, identifying discretionary cash flows for insurance contracts without direct participation features. And third, assessing whether a contract meets the definition of an insurance contract with direct participation features. The amendment to IFRS 17 extends this relief to include the assessment of whether a contract meets the definition of investment contract with discretionary participation features. The next transition relief applies to insurance contracts acquired in a transfer of insurance contracts or in a business combination within the scope of IFRS 3 that took place before the transition date. Applying IFRS 17 retrospectively, an entity is required to classify a liability for insurance contracts acquired in their settlement period as a liability for remaining coverage. However, for some entities, it might be difficult to identify insurance contracts acquired in their settlement period before the transition date, separately from other contracts acquired or insurance contracts issued, because previously their systems were not set up to do so. Therefore, the Board has provided transition reliefs both in the modified retrospective approach and in the fair value approach. Those reliefs permit an entity to classify such a liability as a liability for incurred claims instead of a liability for remaining coverage. As mentioned earlier in this webcast, an entity is permitted to apply reliefs in the modified retrospective approach, including those reliefs we have discussed in this webcast, only to the extent the entity does not have reasonable and supportable information to apply a fully retrospective approach.
Lastly, we have two amendments relating to the risk mitigation option in the variable fee approach. As a reminder, an entity is permitted to apply the risk mitigation option only when specified conditions are met. IFRS 17 prohibits an entity from applying the risk mitigation option retrospectively, because doing so would risk the use of hindsight. Some stakeholders expressed concerns that the prohibition can result in inconsistent treatment of risk mitigation activities before and after transition, and in response to those concerns, the Board made two amendments to the transition requirements. Firstly, the Board amended IFRS 17 to permit an entity to apply the option prospectively from an earlier date, the transition date, instead of the date of initial application. Applying this amendment, an entity can reflect risk mitigation activities in the comparative period consistently with risk mitigation activities after the date of initial application of IFRS 17. Secondly, the Board amended IFRS 17 to permit an entity that has the information to apply a full retrospective approach to instead apply the fair value approach for a group of insurance contracts with direct participation features, when specified conditions relating to risk mitigation are met. Those conditions are met if 1. The entity chooses to apply the risk mitigation option to the group prospectively from the transition date, and 2. Before the transition date, the entity had been using derivatives, reinsurance contracts held, or non-derivative financial instruments measured at fair value through profit or loss, to mitigate financial risk arising from the group of insurance contracts. The Board noted that an entity that uses the fair value approach avoids the situation in which changes in the fair value of risk mitigating instruments, for example derivatives, are reflected in opening retained earnings or equity, while the corresponding changes in the insurance contracts are reflected in the contractual service margin. At the transition date, the fair value of the risk mitigating instrument will include only expectations about future cash flows, and in the fair value approach, the fair value of the insurance contracts at transition will also include only expectations about future cash flows.
Thank you for listening to part 2 of this webcast on the amendments to IFRS 17. We hope you have found it helpful.
Thank you and goodbye.